let's talk more about our gross domestic product. The definition of it is that it's market value of all final goods and services produced within a country in a given time. So as we said before, the GDP is the total output of our economy. More specifically, we say it's the market value of all final goods and services produced within a country in a given time period. So let's talk more about this definition. Let's explain what it means. First part says that it's the market value, meaning first that it has to be a market value, it has to have a certain value, market value, and it also measured in dollars, right? So the value of any kind of goods in the market is measured in dollars. What else does it mean? It means that it has to be marketable. It has to be something that we people are producing with the purpose of selling. So haircuts will be included in this particular in the calculation of GDP if you pay for that haircut. If you grow your own carrot for your own consumption, those are not going to be included in the calculation of GDP. Even though it has value, it's not a market value. Also, it has to be all the final products. We say of all final goods and services. Cars will be included in GDP. The tires that go into production of cars will not be included in GDP. The reason for this, we want to include all the goods and services only once. We don't want to have a double count for certain goods. Another example would be a cake that's being sold in a grocery store will be included in the calculation of GDP. We use the flour and butter to make that cake. So the value of those intermediate goods will not be included in GDP. So we want to make sure that it's included only once. The goods will have to be produced in United States within our borders. So whatever's produced in United States will be included. The iPad that's made in China will not be included. You probably have a question, what if some of the goods are partially produced in United States and partially produced in other countries? If you look at the back of your phone, it may say that it's been made somewhere else. Well, whatever the price of the components that were made in that country, for example, right now I'm looking at my phone and it says designed by Apple in California, assembled in China. Whatever the value of my phone that is from that assemblance is not going to be included. But whatever the design value, right, distribution, that's what's going to be, whatever was produced in the United States, that's what's going to be included in our GDP. Finally, it has to be produced within a particular year, in a given period of time. So 2012 model of Dodge, if you calculate the GDP for 2012, then it will be included in our final GDP calculation. A previous year model will not be included. So GDP is going to have 4 different components. Consumption, which we denote by letter C, is going to be the spending by households on goods and services. So whatever you and I buy on an everyday basis, that's going to be included in the consumption category of GDP. In United States, consumption category accounts for about 70%. That's why we're called consumption nation. We produce and we consume a lot. We consume most of what we actually produce. We consume about 70% of our GDP. Business investment, once again remember that investment in economics is not a purchase of stocks and bonds. That's a spending on firms on capital equipment, inventories, and structures. Whenever you buy a computer that you're going to use in your company, that's an investment. If somebody wants to build a building to have the company located there, that's an investment. If you buy bonds, that's not investment, that's what we call savings. Government spending. Government also spends a lot of money, we all know that. So that's also going to be a component of GDP. It's spending on goods and services by local, state, and federal government. In this category, we're going to include things like government-built roads, buildings, transportation, infrastructure, all those things. Police work. Government is paying salaries to police worker. That's going to go into the calculation of our GDP. What we're not going to include in this category is what we call transfer payments. Like social security spending, that's not going to be included in GDP because it's simply transfer from one group of people into another group of people. Retired people are not producing any services. They're simply receiving back what they paid in taxes. Police, on the other hand, national defense, those people are producing services and thus we include their salaries in the calculation of GDP. Finally, we want to also include net exports. And the net exports is the difference between exports value and imports value. So whatever we produce in United States but sell abroad is going to be value of exports. And whatever we purchase from other countries, that's going to be value of imports. That's why people say the more imports we have, the less GDP we're going to have. Well, that's not really necessarily true. What we're saying, even though we're subtracting value of import, in fact, imports are simply not included in our GDP. If you purchase a TV from China, you spend $500 on that TV. So that spending is going to go into two categories. First, it's going to go into the consumption category because you purchased that TV, even though it was made in China. Yet later on, we're going to subtract it because it was value of an import. So in a way, that TV did not really negatively affected our GDP. It simply was included and then excluded. Thus, the overall effect is zero. Another different kinds of GDP we can discuss, and you may hear about this, is real and nominal GDP. When we talk about nominal GDP, we're talking about the production of goods and services valued at current prices. So for example, if we produced 10 pens today and each one of them costs $1, we produced $10 worth of goods. We measure in GDP in current prices. But as we know, from year to year, inflation happens. So yesterday some goods were cheaper than they are today. So let's say if our pencils or pens are $1.20 tomorrow, right? So and we still produce 10 of them, we produce $12 worth of goods. Does it mean that we really increased our production? No, not at all. Simply prices increased. So our nominal GDP will be higher, but that's not what's important. What we really care about is our real GDP, and that will be adjusted for inflation. So we say that real GDP is the production of goods and services valued at certain base year prices. So we take a certain year and we say, this is going to be my base year. I'm going to assume that the prices stay the same as they were in that particular year. And then every year we measure how much we produce, evaluate all of those goods at the base year prices, and then we are able to see whether or not our GDP increased because we produced more, rather than measuring both the fact increased production and increased overall prices. So how do we measure this growth? Why is that important? So as we said before, GDP by itself shows the absolute value of all the goods and services produced, right? It's, once again, if we produce 10 pencils and each one of them is valued at $1, we produce $10 worth of goods and services. What's more important to us, whether or not this year we're doing better than we did last year. It's nice that you're making $50,000 a year as your salary. But to really see whether or not improving, you probably want to see whether or not your salary is increasing from year to year. Because if today you're making $50,000 and 20 years from now you're still making $50,000, it means you really stay where you were 20 years ago. We don't want that to happen. That's why we care about GDP growth. So how do we measure that growth of GDP? And what do we care about when it comes to its measurement? Well, most of the times we're going to care about percentage change of real GDP. So that's how we denote it. Percentage. This triangle is called delta, which stands for change. Percentage change in real GDP equals to real GDP in a particular year minus real GDP in the year before divided by real GDP in the year before. So we take what we made today minus what we produced yesterday divided by produced yesterday. So in a way, any kind of percentage share we measure as new minus old over old, kind of general notation of the formula, and that's exactly what we're going to be using here. And our GDP growth, percentage GDP growth, is nothing else but our economic growth. Are we improving from a year before? As we said before, economic growth can be negative. It means that this year we're producing less than we did last year. And if we have negative economic growth for 2 consecutive quarters, that's a situation that we said we're going to call recession. So who calculates the GDP and GDP growth? Bureau of Economic Analysis, BEA.gov is their website, calculates the GDP. They're measuring how much our economy is producing. I encourage you to visit their website and look at some of the figures they're showing you. So to see what our current GDP is and how much we're currently producing and whether or not we are improving compared to the previous years. Couple of last words about GDP. We say that it's a pretty good measure of our economic well-being. GDP per capita is even better measure. GDP per capita is how much we produce in United States per person. So we take our overall GDP divided by number of people, and that's going to tell us some story about our economic well-being. If you actually look at the figures of GDP per capita, you're going to see that it's really close to kind of average income in the United States. And if compared to other countries, you're also going to see that just looking at the GDP per capita tells you a lot about standards of living in different countries. But GDP, of course, is not a perfect measure of our economic well-being. First of all, it's not including unpaid economic activity. As we said, the goods that you produce at home for your own pleasure are not going to be included in the calculation of GDP. Such things as if you give a haircut to your husband or if you stay home to take care of your kids, you're producing certain value, but that value is not going to be included in our GDP. It also doesn't account for the environmental issues. It costs a lot to be cautious with the environment. That's not included in GDP. It also doesn't give our value, it's not including our value judgments. So a lot of times we put a value into certain things which is not going to be included in GDP. It doesn't account for the leisure. In United States, people have, I don't know, about 2 weeks vacation. In some other countries, people have 6 weeks of vacation. On the other hand, in the United States, people may work from 8 to 5. In other countries, people have to work from 8 to 8. So it's not only including how much it's only including how much we produce, but it doesn't account for much leisure people actually have. And GDP is also not concerned about distribution of income. We say it's measuring pretty well our economic well-being, but it doesn't tell us how many people we have that are making decent living and how many people we have that are below the poverty